I don't want all of the Chinese system, but I certainly would like to have the financial part of it in my own country.
Charlie Munger, a renowned investor and the business partner of Warren Buffett, invested $45 million in Alibaba stock, China's leading e-commerce, cloud, and financial technology company. Munger first invested in Alibaba through the Daily Journal Corporation in the first quarter of 2021 and almost doubled his investment in the third quarter as the stock continued to fall. In this video, we'll explain why Charlie Munger invested in and bought more shares of Alibaba, major events since Munger's first purchase, and analyze Alibaba's stock and valuation. To start, Munger first bought Alibaba stock in the first quarter of 2021 after Alibaba faced a number of major regulations, including a cancellation of Ant Group's IPO, Alibaba's $300 billion financial technology business, and a $2.8 billion fine for anti-competitive e-commerce practices. After these regulations, Alibaba's stock declined significantly, falling from an all-time high of $319 per share to around $230 per share in the first quarter of 2021. Charlie Munger is known to make big bets when opportunity arises, and this time he took advantage of the sell-off in Alibaba stock to invest in one of China's leading technology companies. After waiting over 6 years before making an investment, Munger allocated an estimated 10 to 19% of the Daily Journal Corporation's portfolio to Alibaba at a cost basis between $225 and $270 per share. However, since Munger first bought shares of Alibaba, a number of major events have happened with Alibaba and China's stock market, including more tech regulation, macroeconomic concerns, and new updates regarding Alibaba's business strategy. To start, a number of new regulations were unleashed on China tech companies. The main sets of regulation target data security, anti-monopoly, education, on-demand services, gaming, media, and financial technology. After each of these sets of regulations came out, this led to increased negative sentiment surrounding China tech stocks. This increased fear regarding investment into the region led certain funds to forcefully liquidate their holdings in China tech companies such as Alibaba due to career risk and risk management, with pension funds and mutual funds selling out of Alibaba, as well as certain hedge funds shorting the stock. This has created significant downwards pressure on Alibaba's stock price. Without institutional fund flows and support, Alibaba's stock fell over 50% from its all-time high. In addition to regulation, many investors have also expressed increasing concerns about China macroeconomic events such as the Evergrande real estate collapse. This macro event led to additional selling in China equities, with Alibaba's stock serving as a proxy for macro and event-driven hedge funds to short, resulting in additional headwinds for the stock. While many external events have impacted Alibaba's stock, Alibaba also reported a number of important updates regarding the company itself. Since Munger's initial purchase of Alibaba stock, the company revealed a number of key announcements, especially regarding its plans for capital allocation. Let's start with one of the most important updates: Alibaba's reinvestment plan. In the beginning of 2021, Alibaba's CEO stated that they plan to reinvest all of their incremental profits in the 2022 fiscal year. Management is expecting Alibaba to grow revenues 30% year over year to over $140 billion in the 2022 fiscal year, but reinvestment means that Alibaba will likely report flat or low earnings growth during this time period. The negative earnings expectations due to reinvestment appear to be somewhat reflected in Alibaba's stock price, but if the duration of the reinvestment cycle lasts longer than expected, then this could further drag down on Alibaba's stock. While Alibaba is increasing reinvestment into its own businesses, the company also announced that it would be investing roughly $15.5 billion across 10 initiatives that promote common prosperity in China. While some investors have interpreted this investment as a party donation and misallocation of shareholder capital, looking at the larger picture, this appears to be a smart strategic move from the perspective of Alibaba. With Alibaba in the crosshairs of numerous regulations, supporting initiatives that promote common prosperity is likely to improve relationships with both officials and regulators. In addition, Alibaba operates a major investment business, having invested in hundreds of startups. Rather than seeing this situation as a donation, another way to interpret this is simply a more focused and socially aligned plan for Alibaba's investments, in which Alibaba would still be able to benefit from a traditional investment fund perspective. In addition to reinvestment, Alibaba's management also stated that it would be increasing its share buyback program from $10 billion to $15 billion through 2022, the largest buyback in the company's history. Management also announced that it had already bought back about $3.7 billion of its stock since April 1st, 2021. Share buybacks help reduce shares outstanding and is one way for management to maximize shareholder value. This buyback program also reflects the belief of Alibaba's management that their stock is undervalued and signals confidence in the company's fundamentals. While many events following Munger's initial purchase of Alibaba stock have been relatively negative, one way to analyze this situation is that the stock has now been de-risked in a number of ways. With a $2.8 billion fine, numerous sets of regulations implemented, increased compliance, and capital allocation updates, Alibaba has faced major consequences and has made announcements that help decrease speculation regarding future outcomes and activities for the company. This, coupled with a cheap valuation due to forced selling and regulatory overhang, has led to an attractive investment opportunity in the eyes of Charlie Munger, who decided to increase his position in Alibaba by 82% in the third quarter of 2021. Charlie Munger has emphasized the importance of taking advantage of investment opportunities and to be prepared when these opportunities arrive.
You know, the game in our kind of life is being able to recognize a good idea when you rarely get it. And I think that's something you have to prepare for over a long period. What is the old saying, that opportunity comes to the prepared mind?
Moving on to the numbers behind Alibaba stock, we can analyze its financials and relative valuation. Starting with the company's financials, Alibaba generated $31.9 billion in revenue in the second quarter of 2021, which increased 34% year over year. While revenue growth is strong, especially given Alibaba's massive scale, what's important to emphasize is that a large amount of Alibaba's revenue growth is coming from acquisitions. Since a significant portion of Alibaba's double-digit revenue growth is driven through inorganic growth, this could pose a risk to the company should their M&A slow down. Alibaba's higher revenue growth is also due to the company's heavy reinvestment into initiatives such as Taobao deals to drive top-line growth at the cost of near-term profits. To measure Alibaba's profitability, we can analyze the company's net income and free cash flow. Starting with net income, in the second quarter of 2021, Alibaba generated $6.7 billion, which increased 10% year over year. For free cash flow, Alibaba generated $3.2 billion in free cash flow, which decreased 43% year over year. This decrease in free cash flow was primarily due to a partial settlement of the $2.8 billion fine that Alibaba announced it would pay earlier in the year, as well as increased reinvestment. Looking at Alibaba's profitability trends over the years, Alibaba's gross margins, normalized net income margins, and unlevered free cash flow margins have declined significantly. Alibaba's declining profit margins are mostly due to the company's expansion into more asset-heavy businesses. While Alibaba started as an asset-light e-commerce marketplace, the company expanded into other businesses such as food delivery, video streaming, and logistics to expand its ecosystem and keep up with competition. However, each of these businesses required significantly more reinvestment and had higher capital intensity, and as a result, have driven down overall profit margins for the company. When it comes to Alibaba's balance sheet, the company has a strong cash position. In the second quarter of 2021, Alibaba had $28.1 billion in total debt and $74.9 billion in cash and short-term investments. After subtracting debt from the amount of cash and short-term investments, Alibaba has negative $46.8 billion in net debt, or $46.8 billion in net cash. Moving on to relative valuation, we can use Alibaba's earnings and free cash flow to calculate price multiples for the stock. Alibaba stock experienced significant multiple contraction, with its multiples following to major lows. Each of these ratios is significantly lower than the company's 5-year historical multiples of 25 times and 27 times respectively, while also remaining lower than comps. If we backed out Alibaba's net cash and investment portfolio, the stock would appear even cheaper. We can estimate the value of the portfolio by using the book value of Alibaba's investments on its balance sheet, which was around $70 billion in the second quarter of 2021. After applying a 40% holding company discount to account for tax and illiquidity considerations, this results in a fair value of about $42 billion for Alibaba's portfolio. Using a reverse sum of the parts valuation, after backing out the portfolio along with $47 billion of net cash, this implies that Alibaba's core business was only worth about $290 billion at its lows. In terms of earnings and free cash flow multiples, after backing out the portfolio and net cash, Alibaba's forward earnings multiple would be around only 12 times, and its forward free cash flow multiple would be around only 13 times. Charlie Munger has emphasized his preference for quality in investing, even willing to pay a premium for high-quality businesses and management teams. Alibaba appears to fall under Munger's framework of quality, representing China's leading e-commerce, cloud, and financial technology business with high returns on invested capital. Meanwhile, Alibaba's significantly discounted valuation makes the stock even more attractive to Munger, as it potentially presents an opportunity to build a position without significantly overpaying for the stock. Munger's decision to double down on Alibaba stock signals the high level of conviction that he has in the company, management, and overall investment. With a long-term time horizon spanning decades and a high level of patience, Munger's large investment in Alibaba may take a while to play out, but could end up being one of his top investments in the future. Subscribe to stay updated for new videos, and comment down below what you think about Alibaba. You can also check out the newsletter in the description below for more updates.